The subject matter this afternoon is a broad one, and it's basically relating to our economy as we see it now, and I can't quite ever keep up with which QE we're in, whether it's quantitative easing 1, 2, 3, 4, or 7, but wherever we are in that matrix. We're watching the federal government take a variety of actions to incentivize or to spur the economy, and we're seeing certainly the stock market at record highs today. But we're going to talk about both the opportunity that those events and transactions provide, and hopefully provide some useful information to you, but also the fear of what's causing and what the consequences of those sets of actions today. And we have a very distinguished group of speakers and panelists, and I'll start by first of all introducing Luke Frobe. Luke is a professor at Vanderbilt at the Owen Graduate School. He's the William C. Emig Associate Professor from Free Enterprise and Entrepreneurship. He joined Vanderbilt in 1993 as an expert in economics and competition policy. From 2003 to 2005, he was appointed Director of the Bureau of Economics at the Federal Trade Commission, where he served as Chief Economist, and worked in the antitrust agencies widely used in his merger practices to predict anti-competitive behavior. He earned his AB in economics from Stanford and his PhD in econometrics at the University of Wisconsin. He is also the author of several books, including The Managerial Economics, A Problem-Solving Approach. Howard Lutnick joins us as Chairman and Chief Executive Officer of Cantor Fitzgerald, one of the world's leading financial service firms, a preeminent capital markets investment bank. Cantor is recognized for its strengths in the equity and fixed income markets, its global distribution model, and for its expanding presence in the leading independent middle market investment bank. Mr. Lutnick also guided the rebuilding of Cantor following the devastating September 11, 2001 World Trade Center terrorist attack that claimed the lives of 658 of the firm's 960 New York-based employees. Since then, Cantor has provided over $180 million to help the families of the firms and the colleagues who perished. Roger Ferguson Jr. is President and Chief Executive Officer of TIAA-CREF, the leading provider of retirement services in the academic, research, medical, and cultural fields, and a Fortune 100 financial services organization. Mr. Ferguson served as Vice Chairman of the Board of Governors of the Federal Reserve System. He was a voting member of the Federal Open Markets Committee, served as Chairman of the Financial Stability Forum, and chaired the Federal Reserve Board committees on banking supervision and regulation, payment system policy, and reserve bank oversight. He holds his BA, JD, and PhD from a Boston-based university you've probably all heard of, Harvard. Robert Whaley is our much decorated Valerie Blair Potter Professor of Management at Vanderbilt. He is established as an expert in derivative contract valuation and risk management and market operation. He's been the consultant for many major investment houses, security, future options, and stock exchanges, governmental agencies, accounting, and law firms. Professor Whaley developed the CBOE Market Volatility Index, fondly known as a VIX, for the Chicago Board of Options Exchange in 1993, the NASDAQ Market Volatility Index, VXV, is that right, Bob? Is that correct? Yeah. Okay. In 2000, and the Buy Right Monthly Index, the BXM, in 2001. He has also developed the NASDAQ's OMX Alpha indices. He received his Bachelor of Commerce degree from the University of Alberta and his Master's in Business Administration and doctorate degrees from the University of Toronto. His past teaching positions include Duke University, the University of Chicago, and the University of Alberta. Michael Brakebill is the CFA and Chief Investment Officer of the Tennessee Consolidated Retirement System. Mr. Brakebill restructured the teacher retirement system of Texas, a $6 billion mid and mid-cap portfolios in 1997, and was asked to lead the Tennessee retirement system of $55 billion domestic equity portfolio in 1999. The TRS domestic equity 5-year returns scored as second out of the top 20 large public funds during Mr. Brakebill's tenure as director. As Chief Investment Officer for the Tennessee Treasury, Mr. Brakebill manages the assets of $33 billion of Tennessee's consolidated retirement systems, the $7 billion state government and local government investment pool, and holds a baccalaureate education systems and chairs the Excellence in Education Forum. So that's our panel tonight. I hope that you'll enjoy that. We're going to start off with letting each of the panelists open and sort of frame some of the issues, and then Luke Frobe will lead us in a discussion. So Howard, if you would start.
So I'm the leadoff batter from New York. That means I'm Derek Jeter, not as good looking. You know, the women just don't treat me the same way they treat him. I just don't understand why. It just doesn't make any sense. So Cantor Fitzgerald, it has a certain place in the business world. We are a middle market investment bank, and what we are expert at is distribution. So our job is to help mid-sized companies buy and sell what they want to do. And we have another company, our public company called BGC Partners, does the exact same thing for all of the largest banks and investment banks of the world. So Bank of America, Goldman Sachs, Morgan Stanley, Deutsche Bank, you name it, when they want to buy and sell, they rely on our distribution system. As an example of one of the things we do is we operate the government securities market in the United States. Something nice to do, and our computer system does that. So from that vantage point, I want to talk a little bit about quantitative easing, what that means for all of us, and where there are opportunities of investing and where things is going to get a little scary. So what is going on today is pretty simple. There is a giant weight on interest rates in America, a giant weight, and that weight weighs about $7 trillion, sitting there pressing upon short-term interest rates. And quantitative easing, I've been saying this on television for years now. QE1 brought in QE2. I always wanted to go on the QE2. I thought this was a different ride that we're all taking. And then QE2 brought in QE3. And until we get an economy, a fundamental economy, and real growth that makes us all feel good, and we are the best examples of how to understand when you have that economy. If we have that economy, you'll all feel it. Do you all feel it now? No. That's because we have 2% growth. What does 2% growth mean? It means we all say no. So right now, we have 2% growth and we don't have an economy. That means the U.S. government is going to continue to lay out the dough and keep pressing short-term interest rates down to the ground. And how long is that going to last? It's going to last until $7 trillion comes out. Now, the problem the federal government has is a pretty simple one. We're talking about it. Everybody on TV is talking about it. Everybody knows about it. It's the opposite of a secret. So when the government tries to take that money out, when they reach that paw in and touches it for the first time, every analyst in the world is going to go crazy. And they're going to start writing, oh, here it comes, here it comes. And when they start taking that money out, everyone assumes, which they've all incorrectly said for years, that interest rates are going to go up. See, they thought interest rates were going to go up because they worried too much about us, right? You got to remember the reason interest rates don't go up is because what's the alternative to buying our debt, right? Remember, we issue government bonds with the pictures of our presidents on them. This is really important because if we want to pay off our debt, we just print it and pay it off. So we can't go broke. We can devalue, we can lower our standard of living, but we can't go broke. When you start issuing your bonds or your money with pictures of bridges on it, like the euro has done, that's bad because we all know the story that when you borrow in other people's currency and you elect politicians to spend your money, you're going to go broke. It's a 100% score in the history of finance. If you borrow in other people's currency, you go broke. So either Europe will combine in the United States of Europe, or eventually they're going to have to go broke. Because eventually a politician will come in, spend just a chunk of dough, right? And then leave it for future generations to pay off. And unfortunately for them, as opposed to us, they'll have to pay it off. We can print the $1 trillion coin, flip it, and now our deficit's only 15 trillion. Hey, you want to do it again? 14 for you. So that's what makes our economy better, right? We're borrowing in our own currency, but we are laying $7 trillion of liquidity out there, which means we are going to have vastly low interest rates for a long, long time. Because what's going to happen is, normally, if we grew 2%, and then another year we grew 2%, and then another year we grew 2%, sooner or later there would be enough slack taken out of the economy where you'd feel a tug, and interest rates and the economy would start to grow. But the problem is we have $7 trillion of liquidity out there, and when the Federal Reserve reaches in to try to take it out, everyone's going to take long-term interest rates up. Not short-term interest rates, but long-term interest rates will go up probably 100 basis points within 90 days, okay, right away. So the Fed is going to have to, in my opinion, move very delicately. Meaning they'll move, but when they first take out the first $250 billion, they're going to stop and say, no, we're done, stop, we're not taking it all out, no. So it's going to last longer. So my view is low interest rates are going to remain an inordinate amount of time for practical reasons and then for prophylactic and protective reasons. So interest rates are going to stay too low. What does that mean? It means real estate is going to perform brilliantly. So if you manage yourself, you'd say, okay, what assets do brilliantly with desperately low interest rates, and which ones are very difficult, right? And that balance is a way to consider what to invest in and what not to invest in. So real estate will perform very well. People thinking about it all the time. When you see Blackstone invest in residential rental properties, it's because they feel that interest rates are going to stay low for a long, long time. So real estate does very well. What else does really well? Diamonds, artwork, right? Vintage cars. Anything that we all thought used to have a cost associated with it, right? You want to buy a fancy piece of art and hang it on your wall? You used to think to yourself, if I spend all this money on a piece of art, you know what that cost me? The opportunity cost of having your money hanging on the wall. Now, looks pretty, and what's my alternative? 0 interest rates. What you're going to see, so number one, you're going to see all those sort of what I'll call bubble assets continue to rise. And they will rise too far. The reason they will rise too far is because interest rates are going to stay low for too long. Next, think of what happens otherwise. I'm a retiree. How long can I afford to earn 0 on interest, right? How long? So I wait a year. I can live with 0 for a year. I can live with 0 for 2 years. By 3 years, I can't take it anymore. I have to go out and buy something. So what do? I say, well, let's go buy Coca-Cola bonds, Walmart, a good company, solid company. What do I get for that? You call your stockbroker and say, what do I get for that? He says, 1.25% for 5 years. You go, what? That's not an interest rate, that's Starbucks coffee. Don't forget, U.S. Treasury 2-year notes trade at 0.2. What is 0.2? That's not an interest rate, it's a storage charge, right? In Germany, there's negative interest rates because it's a storage charge. So the government gets to borrow and a storage charge, okay? And do they borrow for 10 years now? No, of course not. They borrow for 10 years, lend it to themselves, and have it call it QE2, or QE3, or QE4, or QE5. So what ultimately happens is what has changed about the capital markets in America is a reasonable return for relatively constrained risk has been crushed out of the market. You can either take virtually no return for a good company, or you are forced to buy real risk-related assets. You have to buy a junk bond, something below BBB, to earn 6%. To earn 6% for 5 years. So what ends up happening is you get the stock market hitting a new high and nobody participating, volumes down 30, 40%. You get high yield trading better and better and better because we're all forced to buy something with yield associated with it. And an opportunity, so we talked about the opportunity of real estate, right? And commodity, not commodity-based, but storage-based assets, gold, right? When will gold crack? Everybody talks about, gee, gold is so high. When's it going to crack? Simple. Interest rates go up, gold goes down. This is not a hard thing to figure out. When interest rates are zero, storing your money in gold is not senseless. When interest rates are 8%, no one wants to store their money in gold. So that relationship is steady and it's clear. And so what are other opportunities? The opportunities will be done in structured products where people will go out to find something rare. There's a lot of real money seeking alternative investments that have reasonable risk for a reasonable return. And that generally is too frictional for people to actually have it be of size and scale. Okay? And what happens is now people are going to be much more open to it. So people in the financial service business will have the opportunity to create products that you've never seen before in your life. And they're going to come to you. For instance, I saw someone presented me with an opportunity to do the business of spectacular signs, like the Times Square kind of signs. And the thing about those signs is they're not really financeable, right? Because you're just renting a spot on a building, you put up a sign, you have to, the yield on it maybe is 10%, and it is like a mortgage. It pays off over time, and at the end you own nothing. So who would invest in that before? The answer was nobody. They were very hard to finance. But now there is a clamoring for people to put their money in. It's collateralized, it has a steady income, and you can earn net of all fees 8%. Pretty good. All of a sudden, things that no one would ever buy before, where in your brain you would have said, I need a 15% return, you're all recalibrating back to 8. My experience is everyone I talk to who's a regular person thinks the term 8% is the right answer. Sure, I do that for 8%. Where did that come from? I have no idea. I ask everybody, what are you guys thinking? Is that the number? Right? People say, would I do that? Yeah, 8%. So I think the opportunity is going to be to keep your mind open for risks that are constrained risk. If it sounds like Bernie Madoff, it is Bernie Madoff. Okay? That means no one needs you to write a check to them and do this and that. Those are all bad ideas. The proper structure and the proper opportunities are going to be created. Smart people are going to do a lot of work now to create opportunities to invest that you've never seen before. Okay? And you're going to need to do them because my prediction is the U.S. economy is going to grow at 2% for a good long time, at least 3 years, every year. Europe is going to do worse for the next 3 to 5 years. Interest rates are going to stay effectively nil in the short end for at least 5 years. Thanks.
That was superb, Howard. Now, one of the great challenges of doing what I do is Howard is a broker. He's in the market day in and day out trading. I'm representing now what you would think of as a real money investment firm. So I represent TI-CREF. Some of you know us quite well, many of you don't. We are, as you heard in the introduction, a firm that deals in retirement, in particular for individuals, plus more, and we manage about $525 billion of assets. Now, my compliance people would normally say we managed $502 billion because that was the number as of the end of December, but I actually watch it on a daily basis, and it's actually more than that. Before I go any further, I want to say a quick hello to a friend of mine, Dewey Dane. Some of you may know him, some of you may not. He has been a professor here at Vanderbilt for many, many years. I think probably at the age of 94, maybe emeritus now, I don't know. But Dewey preceded me at the Federal Reserve and was one of my real heroes and mentors, so Dewey, pleasant to see you as well. So let me just take a moment and tell you how real money investors are dealing with the world that Howard has just outlined in very articulate and colorful language. First, the facts, as Howard has said. Everyone knows the Fed's balance sheet is up now to about $3 trillion. When I was there, the largest day of the balance sheet was slightly over $1 trillion, and that was because of some emergency funding that we had to do around 9/11, as Howard knows. And so these numbers are ahistorical by the standpoint of anybody who's watched the Fed as I have and as Dewey has. So what has the impact of QE, the various QEs been? Howard has given you a general overview. Let me give you some specific details. First thing, interest rates have fallen around 125 to 200 basis points from where they were when the Fed first started all of this. Credit spreads, as Howard's indicated, on risk assets have tightened in around 400 to 1,000 basis points. So as Howard has indicated, what that means is that the return on risky assets is not that much greater than the return on risk-less assets. And that is exactly the outcome that the Fed wanted. Why do they want that? Well, their goal is to spur job growth and economic growth by making it cheaper for companies to raise money to build plants, to buy equipment, and to hire workers. They have managed to get that to some degree, but still, as they've said, unemployment remains stubbornly high, even at 7.7%. The other thing the Fed has been doing is they have been targeting specific purchases, particularly in money-backed securities, that's managed to lower interest rates on the 30-year mortgage down from about 6.5% to something like 3.5%. The last time interest rates on conforming 30-year mortgages were this low was back in the 50s and 60s, and so we're living in, again, an ahistoric time. Having said all of that, as Howard's indicated, while the Fed is pumping money into the system, they are only getting a slow and gradual return to normality, and I agree with Howard, we're likely to see 2% growth for some period of time. So what does all of that mean for those of us who are in the real money investing business? First, we've seen lower all-in yields on all the assets that we purchase to support our retirement savings products, in our case TIA traditional. We've also seen that with low interest rates, you're seeing what's called an increase in the duration of liabilities, shortening the duration of our assets, so the duration gap is starting to widen for anyone who runs a pension activity. That said, we are still finding some opportunities to make reasonable returns for our investors, and we're doing that because we do fundamental research as opposed to being traders. So Howard's indicated some of the things that look at this stage to be relatively attractive: agriculture, infrastructure, commercial real estate, for reasons that he's pointed out. It may surprise you, though, investment-grade corporate bonds, because of, in some cases, some shortages, have been pretty attractive. Howard's indicated high-yield bonds for sure in emerging markets. The second major point, though, that we've learned in all of this is even in these times of very low interest rates and a search for yield, it is quite important, if you are real money investors, we are to be diversified, and global diversification is critical. And the reason that one has to focus in on that is we've seen that correlations across all asset classes have started to rise. Again, a natural outcome of the kinds of activities the Fed has taken. So you're looking for as much diversification as you can find to try to find those pockets where you find some uncorrelated returns if possible. The final point I'd like to make is, in spite of all of this, there are a number of paradoxes that have started to emerge. Then I'll talk a bit about a point that Howard made, the so-called exit strategy, and then talk about what our outlook might be. So what are some of the paradoxes that we've seen? One of them is, while the Fed is clearly driving down interest rates, as Howard indicates, driving up the returns on equities, real money investors know that those equity returns are to some degree, not fully, but to some degree being supported by this very loose monetary policy. And so all of us are probably holding back on the allocation that we're making to equities, which is an ironic, paradoxical, bullish outcome. Because just as the Fed is trying to encourage investors into risky assets, including equities, many smart investors are saying, wait a minute, we're sure there's going to be some adjustments. So while we are increasing the allocation to equities, we're not going probably as far as the Fed would like, which means that there's probably still some money sitting aside. And Howard sort of indicated that because while valuations are high, the actual depth of markets is not as high as it might have been given the strength of the rally that we've seen. The second paradox, if you will, is that against this very slow growth, profit margins have been rising. And we are now probably 200 basis points above the median trend line for net profit margins in the US. And that's because the cost of refinancing has fallen so dramatically that companies have been taking advantage of those opportunities, and that has raised sharply corporate profits. So one would have been hard-pressed to imagine an economy growing this slowly, but supporting these dramatically increased profit margins, and that is a paradox, second paradox, that's emerged from the Fed policy. The other thing I would say is that, at least when we look at our asset allocation models, we're anticipating, as Howard said, a reversion to the mean over time. So at today's market levels, the expected return on U.S. stocks is about 6 to 6.5% over time, which again is a reflection of that reversion to the mean that all of us should be expecting. And so just as the Fed is trying to drive us into those equities, as one thinks about it, if you take, as I do, and I think Howard does, a sense of reversion to the mean, it really does suggest that you're going to be getting what, by the historical standards of the last 20 years, is a relatively modest return in terms of equities because of the need to get back to a sort of more normalized return. The third of these paradoxes is that the expected returns for stocks internationally are much higher than they are domestically. Because those stocks have been held down a bit or have not experienced the same rally because the central banks overseas until recently have not been printing out or creating liquidity the way we have in the U.S. And so while we think there will be another positive return in the U.S. for equities, it may well be for folks who are thinking of taking a riskier venture into equities that the international space might be the place to look. So those are some of the paradoxes that we see in the world of real investing to mirror and reflect on what Howard has talked about given his brokerage background. So let me now go to the second point, and Howard sort of put his finger on this, which is exit. For those of us who have lived or worked in the central bank world, the new joke is exit is a new four-letter word. So why is that the case? Howard sort of indicated this, right? Markets are very forward-looking. They understand that as soon as the Fed actually starts to get out of the markets, to sell down its very large balance sheet, that they're signaling that they're going to keep doing this, and markets will expect that to occur, and there'll be a dramatic spiking up in interest rates potentially. So you may have noticed the other day, Chairman Bernanke, in response to a question at testimony, opened up a new possibility of exit, which is the Fed will simply keep this very large balance sheet and let its equities, let its investments roll off through gradual maturation over time, which means it could have a very large balance sheet for 5, 6, 7, 8 years from now, and only allow the maturity to emerge then. That has a very interesting set of dilemmas for the Fed, which is whether or not maintaining that large balance sheet, while it would sort of cap some of the risk that Howard's talked about in terms of a spike in interest rates, is that potentially going to fuel inflation? Big question mark, but I would say all of us should be attuned to the various components and hints that the Fed might be giving around what its exit strategy might be. Because it might not be, the point that Howard made of sort of potentially selling off $250 billion or something of that. It might be we leave it alone, they leave it alone, and see how markets unfold. So let me now go to the third issue, which is, well, what's the outlook against all of this? And I agree here with Howard. I think the outlook is a fairly cautious optimism, if I can use that phrase. The economy is, I think, going to continue to grow for about 2%. It serves in the first half of the year, maybe pick up slightly to 2.5% in the second half of the year. We expect rates to stay in a relatively narrow range because it doesn't look as though there's going to be any reason for the Fed to engage in a rapid exit strategy, nor does it look as though the strength of the economy will be such that it's going to support much higher interest rates. There's likely to have, I think, a gradual uptick in interest rates going forward as the economy continues to show some gradual improvement. The second part of the general forecast that I share is around Europe, and I guess I'm still expecting Europe to continue to muddle through. They are slowly addressing their structural issues and the issues of the weaker peripheral countries. The likelihood of a Greek exit or even a British exit or any other exit right now from the euro seems to be moderating. Howard is right to say that the Europeans don't have the luxury necessarily that we have of borrowing in their own currency, and so markets have tended to penalize them if they see poor behavior by seeing spikes in interest rates, which we haven't had. And then the final message I leave to all of you, or with all of you, is, as Howard has suggested, I'm sure there are opportunities to make money in these markets. Be cautious because the Fed is driving a compression in risk returns, and so I think this is a chance for all of us to learn a little bit of a humility, those of us who invest professionally and those of us who are amateur investors, that it's very hard to fight the Fed, but sometimes it's hard to participate and cooperate with them as well. So I'll stop now. I look forward to questions and answers, and we'll turn it over to our next speaker. Thank you.
I'm in real trouble now. I don't talk nearly that fast. I also feel a little uncomfortable in the sense that all of these people are in the markets each day, and I'm sitting in my ivory tower office watching the markets occasionally. But let me give you my perspectives. I have slides prepared because I'm a professor. What I want to do in this set of notes is just describe to you current interest rate policy in the US and in Europe, and then address three questions, which are essentially the focus of this particular session. Is there fear in the credit markets is one of the questions that I'm going to address. Is there opportunity in the credit markets will be the second question, and where are the opportunities? And to some degree, the other panelists have already expressed their views on real estate and art and precious diamonds and all of those sorts of things. But let me get started by focusing in on what the current quantitative easing is. In the US, the Fed is operating in the range of 0 to 0.25%. I think currently it's about 16 basis points. And their promise was some time ago that they're going to stay in that range until unemployment gets below 6.5%. In Europe, the situation is not nearly as generous. The ECB continues to hold interest rates at 75 basis points, and that is problematic, and I'll be talking a little bit about that as I go through the different slides. Is there fear in the credit market? Yes, there is, but I would argue that the fear in the US is actually diminishing, while that in Europe is continuing to persist. And the way I measure that for self-serving purposes, which I'll get to in a second, there's a high correlation between credit risk and expected stock market volatility. Credit spreads are typically the way you measure credit risk. Expected stock market volatility is extracted from the price of portfolio insurance that people pay through the use of S&P 500 options, put options in particular. In the US, the measure of stock market volatility, of short-term stock market volatility, is called VIX, Volatility Index, but these same indices appear in a variety of other financial markets worldwide. In Germany, for example, it's called the VDAX, and the VDAX is based upon the prices of options on the DAX index. You may not know what the DAX index is. You can consider it the equivalent of the S&P 500, for example. Although it only has 30 stocks in it, it has 80% of the German stock market capitalization. That's probably more than the market capitalization that the S&P shares in the US. And so we have those two indices, and what I did is just show you what's happening recently. I just took levels of those indices since the beginning of the year, and what you see in this picture is at the beginning of the year they're at about the same level. But what's happening is there seems to be, oops, I didn't get to my, thanks. They're at about the same level, and what's happening is the gap is beginning to widen. The blue line is the VIX, and you can see the level of market anxiety diminishing somewhat, and indeed, I think the VIX closed at near 11% recently. That's pretty amazing considering if you look at its entire history, the average level was probably 20%. So clearly, as expressed through the prices of portfolio insurance, investors are not quite as worried as we think them to be. I mean, this is a short-term volatility. You can look at longer-term S&P 500 option prices, but it doesn't get all that much higher. And so what you're seeing here is while the anxiety is going down in the US, it doesn't appear to be going down in Germany, and where I'm using Germany as a reflection of Europe overall. You can go over to the level of the stock market and return performance in the US versus Germany. And again, what you see in the blue line is the returns since the beginning of the year for the S&P 500 being quite generous. And on the other hand, the DAX hasn't spiked up until recently, but it's trailing the performance of US markets quite dramatically. So is there opportunity in the no. Quantitative easing has kept interest rates at incredibly low levels. It cannot last forever. I'm interested that Howard suggested it could go on as much as 5 years or longer. That would be great if it did. But I think currently, I can't believe that it can stretch on that much further. And once the Feds step away from all of this and get out of the practice of pushing interest rates down, interest rates are going to rise, and advocates of buying bonds at this juncture are going to suffer immensely as those bond prices fall. The only question to my mind is exactly how they reverse the policy that they have in place, and the big questions are how much, or when and how much, and hopefully it's done in a very slow and methodical fashion. Otherwise, debt holders are going to be in a whole lot of hurt. With respect to quantitative easing, where are these investment opportunities? What I did is I just downloaded some data just to see how the quantitative easing has worked. This graph goes from the end of December 2008 through the present. Quantitative easing, I think, started originally probably in September, and then they changed their minds and shot up the Fed funds rate, and then they brought it back down again. Since the end of 2008, the rate has always been less than 1/4%, getting very close to zero at some points. But what you see that goes concurrently with this quantitative easing is the performance of the stock market in the US. And that blue line represents the rate of return on the S&P 500. I haven't put the number in there, but I believe that's about 72% since the end of 2008. And that's, I think low interest rates are one of the reasons that the stock market is doing as well as it is. I think most of these points have been touched on already, but what other factors are contributing to the stock market rise? Firms have high cash balances. Take Apple, for example, where more than 30% of the company is cash. It's just one of many that are sitting on huge piles of cash. Earnings are generally robust. Earnings announcements these days, if you follow that sort of stuff, are very promising in looking forward. Stocks appear strong. Risk premiums are declining. People aren't demanding as high a rate of return on stocks as they once were, and so if you lower the discount rate of the cash flows, what you'll find is stock prices increasing. And I think another contributing factor, and this has happened recently in a couple of high-profile instances, shareholder activism has gone up. You get people like Carl Icahn addressing the issue of Dell going private. You get people, I can't remember his name at Apple, trying to get the issue of preferred stock given to the common shareholders. These things are all very healthy in the sense that they provide transparency to the marketplace, and you get agents acting on behalf of shareholders. And the managers, the evidence is pretty compelling that they act in their own best interests. We need people monitoring these things, and to the extent that shareholder activists are taking our side, so to speak, I think is a healthy sign. Howard made a comment. I have to put another point in here. Structured products. I agree there's going to be growth in the structured products industry, but many of you probably have been following instances like, let's see, there were bonds issued on Apple shares, and what they were doing is trying to entice investors in by saying that we're going to give you over the next year coupon payments that amount to 8% annually on a monthly basis, and there's no free lunch. If you read closely what goes into that, and what into it is you would wind up getting the shares of Apple if the share price went down by about 13%. And that's exactly what it did do. And these investors wound up with the shares of Apple. In these structured products, the broker gets about 200 basis points, and the product is designed with an embedded fee in it. What went on in that particular product was they were selling to people these bonds which were nothing more than naked put positions on Apple. Now that's atrocious. Many of these investors do not have the authority to sell puts, sell naked puts in the marketplace. And yet investment banks were selling them products, extracting huge fees, brokers were extracting fees. These are not transparent. Many investors are not sophisticated enough to understand what they're doing. Small institutions, many times, are not understanding exactly what goes on in the products. In that sense, we need to be very careful. Those products can get very complex, and because of the way the fees are earned, there's incentive by brokers and investment banks to continue to create these products. And so it's going to call for more investor education than we presently have in place. Thank you.
Hi, good to see you all. Given the title of our panel, I just couldn't resist doing a little homage to Hunter Thompson. My name is Michael Brakebill, so I titled it Fear and Opportunity as opposed to Fear and Loathing in Las Vegas. I thought it was appropriate given that, as we've all discussed and as you all know, the financial markets are being driven by the drug of excess Fed liquidity. So I thought that was a fun way to kick this off. I'm basically going to talk about some of the things that we have seen at Tennessee Consolidated in the markets. It's no different than what everyone else here. Adjustments we're trying to make in the portfolio, and then also, I guess, to make all of us who are Tennesseans feel a little better. Adjustments made into the benefit level to adjust to the world that we're seeing. Quickly, this is an eye chart graph. I won't go into it in detail, but this was a presentation that a graph we took in a presentation to Moody's this summer. And what I really want to illustrate is everybody bats around, is a pension fund 90% funded? Is it 80% funded? What is it? And then you kind of battle over what pension accounting means. Basically, we take money in and invest it, and then we pay people out. This is a graph of that dynamic at work. And what it shows for our pension is that if you take the expected income from dividends and interest plus contributions, we have at least a 10-year period before that cash flow goes negative. So we don't have to sell anything for a 10-year period, which I think shows the long-term nature, just how stable we are. And it kind of illustrates a difference in a long-term pension versus a lot of things. Obviously, the problem, our investment consultant worked with us on putting together a horizon of expected returns for a diversified portfolio. And obviously, as interest rates have fallen over time, we had that expected return of that portfolio has fallen, and we put our 7.5% actuarial number there just to illustrate what that means for us. Local celebrity, if anyone knows, Merle Hazard had a song about the financial markets and quantitative easing, and his famous line, and if you haven't seen it, go look on YouTube or Google Merle Hazard on the internet, is, will we become Zimbabwe or will we become Japan? Well, Zimbabwe, the massive hyperinflation, the corruption and confiscation, they rank 163rd out of 176 in Transparency's Corruption Perception Index. And, as much as you might feel badly about what's happening in Washington, that probably is not what we see. However, if you go to Japan and you look at what's gone on there over the past 20 years, and you think, okay, they had a systematic financial crisis, asset bubble, excess leverage, aging population, and collapse in interest rates. Well, we might not be Japan, but it rhymes. And what would Japan mean? Well, Japan had interest rates collapse, and they've been below 2% for 15 years. So, they very well could, it's hard for us to fathom, it's hard to imagine. I absolutely, as most people, or a lot of people would know, real rates actually have been high, but interest rates have been low for a long time. If we went into this environment, interest rates could be expected to stay low through 2026, 2030, so a very long period of time. And a poor time for investors, especially for pension funds, obviously. What we have done and what we've chosen to do is just make incremental changes. Obviously, we're crawling out on the risk curve like most people are. The pie chart on the left was our original fixed income allocation, and the pie chart on the right is kind of where we took that 40% of the portfolio. And basically what we tried to do was just take a focus on our 40% of the portfolio that had a 1.5% expected return and make it more productive. It's just picks and shovels kind of work. So we took our domestic fixed income portfolio, and we lengthened duration, even though interest rates have fallen for 30 years. It sounds like a crazy thing, and maybe it is. It worked famously when we did it. We lowered our TIPS allocation. We also added high yield and bank loans in a bucket we call strategic lending, and we took some of the money out and moved it to the equity portfolio. So we think we've taken about 40% of the fund from about a 1.5% expected return to about a 3.5%, which is about $300 million a year in our case. On the benefits side, obviously, the investment side alone isn't enough. State Treasurer David H. Lillard Jr. has prepared a plan. It's gone to the state legislature. It came out of the Pensions and Insurance Council yesterday, moving through the process here to change the defined benefit program in the state, and to move basically to have a modified plan, which is a defined contribution and a defined benefit plan. And it has specific caps and specific triggers to very significantly limit the liability of the state. And so we worked on the asset side. We're trying to manage the money as well as we can. And also the treasurers worked on the liability side to keep costs under control as much as possible. So I think it's a great story, and we're trying to, like I said, do as much as we can for you there. So thank you.
says Nashville's just a southern backwater with a bad climate. This is such a treat to have this panel put together, and I want to thank the Dean for putting it together, but I also want to thank our sponsors, the CFA Society of Nashville, Diversified Trust, Mid-South Alternative Investment Association, and Ramsey Quantitative Systems for sponsoring this event. Most of my questions that I distributed to the panel ahead of time were answered by the talks. The one thing, and so I would urge you: do we have a microphone circulating through the thing? So everybody, why don't you queue up behind the why don't you go to the back or go midway down and queue up behind the microphone if you want to ask a question. The one question that occurred to me is that everybody has these plans, these scenarios about, oh, we're going to gradually take all this liquidity out of the system, and everything's going to go smoothly, and we're going to have low interest rates, and that's going to mean this and this and this, and I can imagine that people were saying the same things in 2007, and the best laid plans of Ben Bernanke probably won't come to fruition, and I would just like each or any of you to respond to, so what could go wrong, and what would, if something were going to go wrong, what would it be, and how would you react to it? And what I have in mind is that Howard was talking about an asset bubble. What if one of these asset bubbles pop and the Fed has to react again? Well, if they've shot their wad already, and if they're gonna, how are they gonna take money out of the system? Anyway. So in the famous year of 1987, in April of 1987, interest rates on the long end of the Treasury curve went up 1%. And they continued to go up at a rapid pace every month. And I was comparatively young at the time, and I thought, God, this is terrible. Interest rates are going up at such a rapid pace that something's got to break. And for those of you who remember, the stock market hit, of course, its highs in August of '87. I was shorting everything. I was the age of 26, and I was so broke by August of '87, there was nothing left. But the stock market broke in October of '87 because dramatically rising long interest rates chokes fundamental economic growth. It will choke the equity markets. So the question that's out there is, with all this liquidity damping down interest rates, if they pulled it out wrong, which obviously you heard Roger say is they are clever people who are on it. It's not like they're missing it at any point here. Everyone in the world thinks that interest rates are going to rise, and they're going to rise hard, and they're going to rise fast. And if they do it wrong and they rise hard and they rise fast in the long end, that equity market isn't going to look like that. The gold markets aren't going to look like that, and our economy won't feel this way. Roger, do you do contingency planning for unforeseen, a black swan, say, for example?
Right.
What could go wrong? What's the real downside here?
I think there are a number of scenarios of things that could go wrong. Howard's put his finger on one, right? So a sloppy exit, we'll put it that way, leading to a real spike in interest rates, causing dramatic adjustments or corrections, particularly in equity markets. Obviously, one thing that could go wrong. The challenge around that is that scenario is so much discussed that it seems like it's the least likely thing to happen because it's the big thing that everyone is worried about. Two other things that could go wrong. One is this relative sense of complacency that's starting to emerge around the global economy. Europe no longer looks as dangerous as it did a little while ago. Investors are thinking maybe this is a good time to look at European stocks because domestic stocks, as you saw, are fully valued. China looks like it's okay. but it could slow. So there's a second thing that could go wrong, which is, in spite of these various efforts, there is an external force that creates a real reconsideration among all investors, and things that look like they're pretty attractive now become riskier. The third thing that could go wrong, which seems to me least likely but came up, is, are we in a situation where these interest rates and the clear imbalances that are emerging last for a really long time, which is, we may not be Japan, but it rhymes. Seems, again, highly unlikely that we're in that place. But I suspect very few people 4 years ago thought that we'd be sitting here today with a growth rate that looks like it's going to be 2%, 2+ this year, maybe next year. Unemployment still hovering, whatever it may be, but the numbers start to 7. So the only thing that could go wrong is we actually are in a longer term muddle through than anyone expects. And the challenge there is consistent with some of the things that you saw Professor Whaley put up, having to do with the challenges of an aging population. So having a very low interest rate environment, slow growth in the context of an aging population puts a lot of pressure on all of us. The best thing that we have going for us, and Michael and I have both said it, is unlike Europe at least, markets at this stage seem to be giving the Fed an awful lot of credibility. It is not clear how big the Fed's balance sheet can become. Most of us thought, gee, $3 trillion seems like that's not going to be sustainable, but it's been sustained. So, there's nothing that says, back to your point about what the Fed could do if there's another crisis. If we look at what we have now, there's nothing that says that the Fed can't continue these QEs at this stage. It hasn't been punished at this stage with a rally in interest rates. So while there are lots of things that could go wrong, the big question is exactly how elastic is the Fed's balance sheet? And we don't really know the answer to that one yet. So there are some big uncertainties out there.
And Bob, what do you see as the big long-term risks kind of facing investors in the United States or worldwide?
Well, it would have to do with the level of interest rates. I guess I agree with Howard to the extent that the way the Fed chooses to relax this policy is going to have a profound bearing on long-term investment. I just don't know the way it's going to go. It's just the uncertainty in the marketplace.
Are you worried about asset bubbles forming and popping and?
Yes, I mean, absolutely. If this is not handled correctly, we could.
How can you ask the question that way and get a no from them? Right. We're worried about it popping? No, it sounds great.
Well, it was a trick question to get him on record to admitting that there are bubbles. And Michael, what are you worried about as a money manager?
To me, the big imbalances right now are China and the China restructuring and imbalance there, the imbalance in Europe and kind of restructuring in Europe and the kind of north-south divide there. I think that as far as the Fed removing liquidity and going through this stage, I'm actually a little less, probably maybe less than I should be, concerned about that, because as we walk through this crisis and through each one of the quantitative easings, what we saw happen was that as we got to the end of each one of those cycles, actually the economy would start to weaken and rates would fall as the quantitative easings were going away. So the perverse thing that would happen was the quantitative easings looked like they were going away and rates were falling, and rates would rise when quantitative easings would occur as the economy normalized again. So it was actually a perverse outcome on what you would expect beforehand. And so I look at that more. I think that's why they went and said we're going to do this until we hit 6.5%, because we were doing this stop-start thing between QE1, QE2, whatever, and the economy would start to sag and they would put out another one and then we would rally again. So I'm less concerned about that and more concerned about the global imbalances.
We have a question.
Sure. The question has to do with everybody's focusing on the Federal Reserve and the $7 trillion weight that they've put on interest rates. Well, if you think about that weight as being on the end of a seesaw, teeter-totter, And that $7 trillion weight is picking something up on the other side. And whatever that thing is, it's only just barely offsetting it so that we have 2% growth. I think it's really important to understand what that is that's on the other end of the teeter-totter, and what the dynamics is of that weight lessening to understand what's going to happen with the Fed. What do you guys see as that big weight on the other scary thing on the other end of the seesaw, and how do you see that changing over time?
Well, I'll give you some examples, if you'd like. The Sony building in Manhattan just sold for $1.1 billion, one building. An apartment in Miami, you remember Miami used to be bust, remember that, just a couple of years ago? $3,500 a foot for new construction in an apartment in Miami. So the other side, low interest rates drive commercial real estate prices higher, especially if it coupled with sustained economic growth so that you can project increasing rents. What's happened is a simple model. It's, for those of you not necessarily familiar with commercial real estate, it's something called a cap rate. So commercial real estate investors just look for a certain rate of return. So a 6% rate of return obviously is a less valuable building than a 5% and a 4%. And what's happening now is, as interest rates are so low, those cap rates are coming down and people are willing to buy real estate at a 5% rate of return and possibly a 4% rate of return, and up goes the value of those. Art hits highs every month. Vintage cars hit highs every month. Diamonds hit highs every month. All sorts of things that are non-economy volume based. Gold is spectacularly high on low interest rates. So all those are the sort of basic things that are going to be driven by low interest rates.
So, go
Howard's
ahead,
right. The
Rodney.
only other place that one might look, and Howard's right, it's gone into asset valuations, equity valuations. We've talked about that. The other thing that's happened is that banks are holding a historically large amount of reserves on the Federal Reserve's balance sheet. And so another place where all this has gone, because lending has really not picked up broadly across the economy, is that the banks themselves have a large amount of liquidity that they're holding with the Fed. One of the arguments that the Fed makes about how they're going to do this exit strategy is that they now have something they didn't have when Dewey was there or when I was there, the ability to pay interest rates on these reserves. So one of the other arguments that they're making about how they're going to exit is they're going to gradually pay banks more and more money to hold reserves with the Federal Reserve, which will hold down the risk of big inflation popping up. So the one point that we haven't made is that the Fed's balance sheet has both an asset side and a liability side, and both of them are relatively large at this stage.
Next question.
So we have central bankers around the world and governments trying to debase their currencies. Some are being successful. What are your thoughts, or do you wake up in the middle of the night thinking, could it be a currency crisis that we have? Any of it?
Well, I guess I don't want to speak too much, but I'll speak to that. The reality is that in spite of that risk, we actually haven't seen it emerge, which is highly unusual. So the U.S. has been following a very accommodative policy. Almost every other central bank has followed a accommodative policy. We have not actually seen the kind of currency wars that people have been concerned about. So I think it is something that may be out there someplace on the horizon because this is not sustainable. But to date, the currency markets have actually continued to function quite well and to reflect differentials in values based on differentials in real economy as opposed to thinking exclusively about monetary policy, which has been globally relatively accommodated by historical standards.
Just to follow up a little bit, I think that's what you saw in 2011. I think 2011 was a currency crisis, but it was a euro currency crisis. And so that's been a very real thing. Additionally, if you look at Japan and the 30-year period, the Japanese yen has strengthened just crazily. And so now it's finally given that back up a little bit. But as far as a dollar currency crisis, I don't see that right now.
Hi, thanks. Thanks to all of you for being here. Really appreciate it. So we talked a lot about monetary policy. We've had a couple of fiscal policy headwinds kick in here in the last couple of months, payroll taxes and sequester. I'm wondering if a 2% growth rate is still a reasonable expectation in light of some of those headwinds. We see some evidence in restaurants and different places that maybe it's hitting the consumer's pocketbook a little bit. So is 2% a reasonable expectation for growth in the near term? If we continue to try to address fiscal budget, will 2% be achievable over the 5-year horizon? And what kind of sand in the gears does that throw into our discussion if the growth rates don't live up to those expectations?
So I'm going to tell amongst the crazy businesses that I have a gaming business. We run the sports betting business in Las Vegas. And I'll teach you something about the media, which is Barack Obama versus the entire Republican slate, whoever it could possibly be. In Europe, where you can bet on these things, Barack Obama was a 3-1 favorite. Before they elected, they picked a Republican opponent. Then they picked Mitt Romney, and Barack Obama went to be a 3-1 favorite. And do you remember that debate? You know, the one where Romney whooped him, and the media went crazy? You know what those odds went to? 3-1. So the media needs to sell newspapers. If they had said it's a rout, who's buying ads? So how was your fiscal cliff? How was yours? Right? Do you remember bouncing off that fiscal cliff? Wasn't that horrible? We all went right over the cliff. What's the new thing now? The sequester? We're all going to hell in a sequester? I don't even know what a sequester is, but I don't feel like we're going to hell in it. So I think the media needs to overstate it. What bad would be happen if the U.S., who can pay its debts by printing it, if the U.S. Congress and the President of the United States cross their arms and say, we ain't going to pay, and we just mess with the world and our right to live in the world by just being weird, that is something very special, okay? That is just something very special. But the fact is, I do not think the fiscal cliff, the sequester, or anything else is going to move our $16 trillion economy, plus or minus, our train at 2%. Maybe we're a battleship, maybe we're an aircraft carrier, maybe we're all of it, but we're chugging forward at 2%, with or without whatever the marginal things the government does, in my opinion.
I guess we've got a little pattern going here, so Howard speaks first, I speak second. I don't dispute Howard's short-term view. I think we do have to come to grips with a longer-term issue, and this may reflect a bit more of what I do and things I've studied. So we are confronting something we haven't talked very much about, except I think the professor had one point on his slide about an aging population. So the U.S. is confronting, not as bad as the rest of the world, but we are confronting an aging population that has to do with all of us baby boomers getting closer and closer to retirement age or over. You know, there's one baby boomer that turns 65 every 7 seconds. It's not the same baby boomer, but there are. Can't remember. The second part of the aging formula here in the U.S. is that all of us are actually being blessed with increased longevity. And so not only are more and more of us getting to what's called retirement age, but we're likely to live 20 or 30 years in retirement, highly unusual compared to historical norms. The third part of the aging population is, while there's a big cohort of us baby boomers, the next couple of cohorts, Gen X, Gen Y, millennials, whatever you want to call them, are much smaller. So the reason I raise all of this is we don't have, I agree with Howard, a $16 trillion economy can probably deal with some of the headline excitement that we've had, but we have a fundamental problem, which is many of our programs are structured for a demographic pyramid that looks more like a pyramid as opposed to an inverted pyramid. And so while I think we can sort of muddle through in lots of ways for the foreseeable future, we do have to at some point come to grips with these broader fundamental issues that have to do with programs that are set up to support all of us older people that were created when there was a much smaller percentage of the population that was likely to take advantage of these programs. Social Security, Medicare, Medicaid clearly come to mind. The reason that's important is if we don't do that, markets which have been pretty forgiving of the U.S. issuing more and more debt, at some point we'll start to worry about a debt to GDP ratio that gets to be larger and larger. And the thing that differentiates us from almost others, while we borrow in our own currency, as Howard has pointed out, unlike, let's say, the Japanese, we borrow from others. Savers around the world, sovereign funds around the world, China in particular. And at some point, all of those folks who are willing to lend us money may become less excited about lending us money if they don't think that we can manage our fiscal situation. So I don't think we have sort of a crisis du jour mindset, or we shouldn't, as Howard sort of indicated. But I think we've got not the kind of chronic problem, not the kind of acute problem that gets headlines. We've got this chronic problem that we're going to have to come to grips with in the relatively near future if we're going to maintain credibility in markets, one person's view.
I have a follow-up on that real quick. I think one of the interesting things on both of the previous questions is the fact that is the $7 trillion plus the massive fiscal deficits, and we've done all that and we get 2% GDP growth. I mean, that shows just how bad things are. I mean, so I think that in itself is an interesting observation.
Okay, next question.
Hi, my name is Spencer Patton. Thank you all for being open to questions. My question's for Michael, but really for the rest of the panel as well. One thing that I wonder, as you're planning out a multitude of years of returns for your pension, do you take into account any loss of purchasing power outside of the traditional rate of inflation that's reported? And a good example of that is in 2007, an ounce of gold was $750, and now it's north of $1,500. Gasoline prices, $2, $2.50, now closer to $4. And so the loss of purchasing power that's happened, arguably because of quantitative easing, has dramatically lessened the rates of return that people may think that they're getting over time. And so as you're modeling, do you factor that into the rates of return that you're trying to achieve, knowing that if you haven't done anything from 2007 to 2013, priced in gold, priced in gasoline, priced in many real assets, you've lost a massive amount of your purchasing power?
That's a great question, and just on a structural level, the pension fund has a CPI inflator built into the benefit structure. Obviously, people have difficulties either for or against what the CPI is and what it means. We have investments in the pension fund that are positively correlated to inflation and negatively correlated to inflation, and we try to have those in the portfolio to protect against those. Overall, you can make a case for individual components looking fairly dire, gold, oil, whatever, and people make a lot of cases against the CPI. However, really, inflation has been pretty benign, and I think that most of the indicators, if you look at the inflation flowing through the economy from producer prices and crude goods all the way down to the CPI, they're actually falling right now. They are not rising. And so that's a concern. It's a real thing, but also we worry about the deflationary thing, because the deflation is what 2008 was. So.
Let me ask a final question. Do you see any political constraints on the Fed as it tries to execute its policy? Do you see any loss in confidence or political constraints in the way, or political risks?
I think we saw in Japan, you had long-term economic malaise, followed by eventually the politicization of their central banker, right? So the government goes out and says, I'm going to pick a central banker that's going to devalue the currency. Are you going to devalue the currency? Yes, central banker. And what's he do on his first day? He says, I'm going to devalue the currency. And now there's a sharp guy who gets a job. So we have the risk, right, that eventually, if we are in an economic malaise, right, eventually those two tie. And Japan fought it for 15 years, right, and then lost a very public battle to it just recently. And, it's not soon, but those kind of things will happen over time. And you saw it in Japan, and that's a risk, but not for a long, long time.
Roger?
Look, I agree with Howard on this one. I think the Fed is going to come under a fair amount of criticism, a lot of scrutiny. There will be a fair amount of second guessing. But having watched this for a long period of time through Volcker when he raised interest rates and threw the economy into a recession, a number of other things that have happened, at the end of the day, I think Congress in particular and the administrations in general have historically been quite respectful of the Fed, and we haven't yet gotten to that place. I think, obviously Howard's right. If things go into extremis, then there's a real risk of things, the Fed being restructured in some fundamental way. But I've actually been quite impressed, in spite of all the tough questioning back and forth, that the Fed's come through this reasonably well, and has shown under their leadership a fair amount of resilience around the possibility of political pressure. So I'm a cautious optimist that the Fed's independence will be respected ex some extraordinary outcome.
Okay, well, I want to thank the panel for just a wonderful talk.